Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields again tried to creep higher but fell short of 3%. Even after yesterday's FOMC minutes, we were unable to eclipse the level. It's still well within within reach and is the target, but we have not yet gotten there. We will continue. We continue to stay elevated in yield. We continue to see sellers come in, pushing those yields higher. 291 as we end the day here today on Thursday. But again, we have yet to eclipse that level. Don't forget, we got there at the end of 2013. We briefly touched 3%, but you got to go all the way back to 2011. Since the last time we saw a sustained trade above 3% in the 10-year. So this is a big level to get through, at least to get to and then get through. It is a big level. And market volatility, which has been elevated, has seen a sharp sell-off, seen a sharp decline since the February 9th highs were put in. And lo and behold, that lines up pretty nicely with the same in equity volatility and in equities rebounding. So I think that a lot of the volatility we saw in the bond market may have just been ripple effect coming out of equities. We certainly have not seen that trend change in bonds. It's not like we saw bond yields go up and then come sharply lower, like we saw stocks go lower and sharply higher. It has been pretty much a steady trade. So the elevated volatility, while it isn't spiking the way we saw it in early to mid-February, it is still elevated, well above all those moving averages we like to talk about, and it's a welcomed visitor. Hopefully it's here to stay, but certainly we'll take what we can get when it comes to volatility. We've had so little of it ever since the Federal Reserve got involved in the bond market. And lastly, let's look at the curve. Curve's obviously been trending flatter. 2s, 10s got down to its lows, got to around 50. And then we saw that sharp reversal. We saw it steepen about 30 basis points in a very short amount of time. It looked like it coincided with the rise in volatility and the sell-off in the equities and talk of maybe more aggressive Federal Reserve action. And then things just kind of came back over the last several sessions. We've seen a reversal of about 50% of that move. So while we are still seeing a steeper curve than we saw a short time ago, just a month ago, we are not as steep as we were. And I think that a lot of this is positioning ahead of what could be a pretty big event next week, which is new Fed Chairman Powell's testimony to Congress. He will speak on the 28th, and that could be the beginning of how the market starts to interpret and absorb what he will bring. Obviously, he's going to be speaking then he speaks again after March FOMC. There's a lot of nuances that we don't know about new Fed Chair Powell. A lot of how is he going to react to potential higher inflation, mixed growth, talking about Treasury curve and debt issuance, and a lot of the variables in there that we're not really sure. Is it going to be the new Powell put, as previously was the Yellen and Bernanke put? I'm not sure that the market's totally sold on that yet. Likewise, he brings maybe a new edge because the Fed had already started tightening, that we could see things pick up a little bit, and that obviously would be different than we've seen in a long time. Short rates going up faster than we're used to. So right now the market, it's still trending higher. Volatility's coming off. We do have several key events coming up, none more important, I think, next week than Fed Chair Powell's testimony to Congress. This is Todd Colvin coming to you from the floor of the CME Group.